Welcome to the Hedge Invest Benbridge EM Absolute Return Fund year-end update for 2021 and looking forward into 2022. As many of you will know, EM has had a difficult period over the last 9 months. The market peaked, the EM markets peaked in February 2021 and have fallen about 15% since then, mainly driven by China, as well as a quite strong tightening cycle in emerging markets as inflation has reared its ugly head around the world. And to react to these, we've had quite significant rate hikes across the EMs, as well as quite significant pullbacks in the markets. The US market has continued to power on, driven by the big cap monopolistic stocks, the Teslas, the Googles, the Amazons, etc. In fact, if you remove the top 5 stocks out of the S&P was flat for 2021. Quite an astonishing achievement, given the overall gains were driven by such a narrow group of stocks. In fact, the market breadth has been so bad that almost half of the stocks in the S&P are below their 200-day moving averages, even though the market is hitting new highs. What's been driving all this? This is what we're going to talk about today. What is the macro outlook? What do we see going on? Where are the challenges and where do we see the opportunities? So just a quick recap of where we are on a macro front through our macro model. The US is firmly entering a tightening cycle. The Fed just announced a potential interest rate hikes by March of 2022. The purchase of assets will finish by March, and we'll probably get our first rate hike then, looking at 3 rate hikes in 2022 and then further 3 rate hikes in 2023. So we are firmly in a tightening cycle in US monetary policy. That normally is a negative indicator to emerging markets due to dollar strength and reduced credit flows. On the flip side, China, which has had one of the worst performing markets this year, has already been in a significant tightening cycle over the last 18 months or so, and Chinese credit growth has dropped dramatically, and we are now starting to see the first parts of the easing cycle. So we've got a very dislocated cycle between what the US is experiencing and what China's been experiencing. We haven't seen this sort of dislocation in the cycles for a while, and so this is what's causing some of this discombobulation in the markets. But China is now taking action to ease credit and to try and reflate the economy. We've seen in China a big slowdown due to the property market and the impact of Evergrande and Kaiser and some of the other property developers with the tight monetary policy that China's been running. But we're starting to see green shoots in China on potential easing. We don't think it's going to be a repeat of previous cycles where the Chinese have eased aggressively and reflated the economy very hard. This is going to be a slow and gradual process, but we think that the worst of the credit tightening is now over in China. So we think there's some green shoots there and some opportunities with the Capex cycle going forward. One of the other things that EM and the global economy has had to be dealing with in the last few months is high energy prices. And we think that's going to continue. We think there's a structural deficit in carbon energy production, and we're going to see sustained high energy prices leading to sticky inflation over the next few years. And we think that's a more of a structural theme that we're looking to play, and some of our holdings are in the energy space where we think there is significant dislocation and cheap valuations in energy stocks, which will benefit from this structural cyclical rise in energy prices. The other big things to note and things that we're focused on is on the political front. Tensions remain high between the US and Russia. Tensions also remain high between the US and China. And we also have a US election cycle to look forward to this year in November. So there are a lot of decisions that are being made that we think are political in nature and not economic in nature. And those things always lead to difficulty in understanding markets and understanding the impacts. When policymakers make ideological decisions and not economic decisions, those are the toughest sort of periods in markets to recalibrate and re-understand what's going on. One of the things that we've seen in China over the last year is a significant crackdown on the big cap tech companies. The things like Alibaba, where the Ant IPO was cancelled and they were basically told to start shutting down certain businesses. Similarly with Tencent, where they've been told to divest of many of their non-China holdings, as well as some of their Chinese domestic investments. And so there is a big reshaping driven by politics in markets, and we're carefully watching those and analyzing those and trying to understand where the pitfalls are and where the opportunities are. So moving on to opportunities and themes and how we're thinking about the markets. There's a few different areas where we think there are very interesting things going on, where we're going to be seeing some really interesting investment opportunities. Firstly, as I already mentioned, energy. We've been increasing our energy exposure over the last few months. And we've used the pullback that we saw in November, December to add to those energy holdings, and we're going to continue to add to those on dips and on pullbacks. So we think there's a very strong structural case for sustained high energy prices for the next few years, and until renewables take up a bigger share of the pie. And we think that's something that's going to persist, and the energy companies are going to have a big windfalls. We're already seeing things like Petrobras having 20% dividend yields, as well as things like Lukoil in Russia having 10% plus dividend yields. So we think there's a lot of value and a lot of opportunity in that space. Other big things that are going on, we think that the auto sector is incredibly interesting. This year has seen a lot of new entrants coming into that sector, as well as Tesla now becoming the dominant player in the electric vehicle space with the best-selling car, the Model 3, really driving volumes. Tesla is now talking about selling 20 million cars worldwide by 2030. Now, the global market for autos is approximately 65 to 70 million cars. So Tesla is talking about having a 25 to 30% market share by the end of the decade. There are multiple OEMs who are fighting it out for that market share. We see the auto market as a new frontier. It's similar to when Apple launched its iPhone back in 2007. If you looked at the smartphones back then, around 2008, 2009, there were 6 or 7 different operating systems. Today, the market is dominated by 2 operating systems. So we think there's going to be a huge consolidation, as well as companies who are going to be basically forgotten and destroyed over the next few years in the auto sector as the industry shifts to new technology, new entrants, new players, the disruption that comes from that, and old incumbents lose market share and dwindle. We don't think it's going to be as extreme as the cell phone market, but there are definitely too many automakers all trying to fight for the same market share going forward. So we're very involved there. And looking at winners and losers. Just yesterday, Sony announced that they were going to get into the car making business. So it's a very interesting sector. Other areas that we've really focused on, semiconductors has been one of our best performing trades for the last few years. We've been structurally long semiconductor industry. It's our biggest overweight and biggest holding across various different semiconductor names. And we think that continues as demand grows. As we get AI, as we get smart home products, as we get just more automation in our lives, the need for semiconductors is growing rapidly, whether that be data centers, whether that be the number of chips going into vehicles, the number of chips going into your fridge at home, etc. Everything is becoming connected. and that leads to great growing chip demand, and we think chip demand is going to grow substantially over the next few years. And the final area that we're really starting to focus on now is the new Capex cycle that we think is about to start in the developed world, as the developed world starts to deal with the structural inflation that's coming down the line. There has been a stagnation in productivity and Capex in the developed markets because they haven't needed to. China has filled that gap. China has done all of the Capex. China's done all of the productivity gains. And given the political tensions, the idea of reshoring, etc., we think that the Capex cycle in the rest of the world is going to have to kick in a big way. And one of the big components of that Capex cycle is the introduction of more robotics into the supply chain. And so we think there's a significant opportunity for companies in that robotics sector to shift their sales away from China and grow their sales in the rest of the world. And that's something that we're exploring as a theme, and we've identified a couple of stocks that we're going to be adding into the portfolio over the next few weeks to take advantage of this Capex-driven cycle outside of China. Hopefully that gives you a flavor of where things are in the portfolio and the kind of ideas that we're thinking about. The portfolio was roughly flat in December, and despite the challenging start and the challenging year, we're still very close to our starting point. And we look forward to a 2022 where we can exploit some of these opportunities and try and make some great alpha for our investors. Thank you.